Listen, the gold market is telegraphing something that most people won't understand until it's already happened. Here's a perspective you might not have considered. The relationship between precious metals and the dollar is not what the financial media tells you it is. They're selling you a simplified narrative while the real story unfolds in the data points they conveniently ignore. Right now, we're witnessing something I haven't seen in my entire career watching these markets. Gold is holding strength against a backdrop that traditionally should suppress it. The dollar isn't collapsing. Interest rates remain elevated, and yet gold refuses to break. Silver is coiling like a compressed spring. What we're seeing here is institutional accumulation disguised as retail uncertainty. Let me show you what I mean. When you strip away the noise and look at the actual flows, central banks have been net buyers of gold for 14 consecutive quarters. Not months, quarters. That's 3.5 years of consistent, deliberate accumulation by the very institutions that publicly downplay gold's importance. The People's Bank of China added to reserves again last month. Poland continues stacking. Singapore, Turkey, India, all buying. This reveals something important. The people who actually manage sovereign wealth are preparing for a monetary regime that looks fundamentally different from the one we're living in now. But here's where it gets interesting. The mainstream narrative wants you to believe that gold only works in crisis scenarios, financial collapse, hyperinflation, Mad Max economic conditions. That's the story they've been selling for decades, and it serves a specific purpose. It makes gold seem like a fringe asset for doomsday preppers rather than what it actually is. Monetary insurance for intelligent investors who understand that currencies are political tools, not stores of value. The dollar's strength over the past 2 years created this perfect psychological trap. People watched gold in dollar terms and saw consolidation. They interpreted that as weakness. Meanwhile, gold in euro terms hit all-time highs. Gold in yen terms absolutely exploded. Gold in pounds and Australian dollars and Canadian dollars making new records across the board. What's remarkable about this is gold was screaming a message that only became invisible if you exclusively viewed it through the dollar lens. And that's exactly what they wanted. When you only measure gold against the dollar, you miss the entire point. The dollar index is a relative measure. It tells you how the dollar performs against other fiat currencies, all of which are being debased simultaneously. It's like being the tallest building in a city that's sinking into the ocean. Sure, you're higher than your neighbors, but you're all going down together. Think about the mechanics here for a second. The Federal Reserve's balance sheet expanded by trillions during the pandemic response. The European Central Bank did the same. The Bank of Japan never stopped. China's been stimulating through various channels. This is coordinated global monetary expansion, and the dollar's relative strength simply means the Fed happened to tighten while others kept the spigots open a bit longer. It doesn't mean the dollar is sound. It means it's less unsound than the alternatives in the short term. This is the key insight. We're in a transitional phase where the old monetary order is breaking down. But the new one hasn't fully emerged yet. Gold's behavior right now is exactly what you'd expect during this transition. Consolidation at elevated levels, building energy, absorbing selling pressure without breaking down, institutional buyers stepping in on any meaningful dip. Now let's talk about silver, because this is where the setup becomes absolutely explosive. The gold to silver ratio has been whipsawing, but it's currently sitting in a range that historically precedes major silver moves. When gold is strong and silver starts catching up, you get these momentum runs that shock people who aren't paying attention. Silver has industrial demand that gold doesn't. Solar panels, electronics, electric vehicles, 5G infrastructure, all massive silver consumers. The above-ground stockpiles that existed decades ago have been largely depleted. What we're seeing here is a supply-demand dynamic that's tightening while most investors are looking elsewhere. Here's why that matters. The financial system treats silver like a speculative industrial metal, but silver is monetary. It has thousands of years of history as money. When confidence in fiat currencies erodes, not collapses, just erodes, silver gets remonetized by the market. We saw it in 2011. We saw it in 2020. Both times, silver went parabolic while the mainstream was still debating whether inflation was real. The setup now is arguably stronger than both those periods. Why? Because the fiscal situation has deteriorated to a point where there's no mathematical path to sustainability without either default, inflation, or financial repression. The U.S. is running deficits above $1 trillion annually during what they call normal economic conditions. The debt service costs now exceed defense spending. Social Security, Medicare, and Medicaid are on trajectories that require either benefit cuts or massive money printing to finance. Politicians aren't going to cut benefits in any meaningful way. That's political suicide. So the path of least resistance is monetary debasement dressed up as liquidity provision or quantitative support, or whatever euphemism they deploy. The Fed will claim they're not monetizing debt directly, but functionally, that's exactly what happens when they expand their balance sheet while the Treasury issues trillions in new bonds. This reveals something important about the timeline we're on. You don't need a currency crisis or hyperinflation for gold and silver to perform. You just need the market to gradually lose faith in the purchasing power preservation of dollars and bonds. That process is already underway. It's just not being acknowledged by institutions that have built their entire business models around managing dollar-denominated assets. Let me give you a concrete example. Pension funds and insurance companies are structurally long bonds. They have to be. It's embedded in their regulatory frameworks and liability matching strategies. But bonds have been decimated over the past few years. The worst bond bear market in generations. These institutions can't publicly admit that their core holdings are fundamentally compromised because it would trigger regulatory scrutiny and client panic. So they hold, and they hope, and they pray that yields come back down so their bond portfolios recover. But what if yields don't come back down in real terms? What if we're entering a regime where nominal yields might decline from peaks, but inflation remains structurally higher than the pre-2020 era? That would mean real yields stay suppressed or negative, which is exactly the environment where gold thrives. Not crashes, not chaos, just the slow, grinding realization that traditional fixed income doesn't work anymore as a wealth preservation tool. That's the environment we're moving into, and the smart money, the central banks, the billionaire family offices, the sovereign wealth funds, they're already positioning. They're buying gold, they're buying mining assets, they're securing physical metal while the price is still measured in soon-to-be debased currency units. Which brings me to first mining gold. Now, I need to be clear here. I'm not giving financial advice. I'm sharing information and my interpretation of the data. You do your own research. You make your own decisions. But here's what caught my attention about this company. First, mining gold is essentially a land bank of gold and silver projects in safe jurisdictions. Canada, primarily. They've assembled a portfolio of assets through strategic acquisitions at a time when most investors had written off junior mining entirely. What's remarkable about this is they built this portfolio during the bear market, when assets were cheap and nobody wanted them. The flagship is the Springpole Gold Project in Ontario. Over 4 million ounces of gold, over 20 million ounces of silver in measured and indicated resources. This isn't some speculative early-stage exploration play. This is a defined deposit with a completed feasibility study. The economics work at gold prices well below current levels. The permitting process is advancing. The infrastructure is accessible. Here's why that matters in the current context. When gold moves into a genuine bull market, not just dollar weakness-driven rallies, but actual monetary reset positioning, and the mining sector historically amplifies those gains by multiples. A 50% move in gold can translate to several 100% moves in producers, and even larger moves in developers with quality assets. Most retail investors miss this leverage entirely because they show up late. They wait until gold is making headlines, by which time the mining stocks have already doubled or tripled from the lows. The people who make asymmetric returns in this space are the ones who position before the narrative shifts mainstream. First, mining gold's strategy is interesting because they're not trying to be everything to everyone. They're focused on advancing Springpole while monetizing other assets in the portfolio to fund that advancement. They recently optioned out the Pickle Crow project to Evolution Mining. That brings in funding without diluting shareholders. It validates the quality of the assets, and it allows management to focus resources on the highest value opportunity. This is the key insight about junior mining. Capital allocation is everything. The graveyard of this sector is littered with companies that spread themselves too thin, chasing every shiny object, diluting shareholders into oblivion. The companies that actually create value are the ones with discipline. They focus, they execute, they partner strategically rather than burning cash trying to do everything internally. What we're seeing here is a company that understands those dynamics. Dan Wilton, the CEO, comes from a corporate development background. He understands deal structures. He understands how to navigate the capital markets without destroying shareholder value. That matters enormously in an industry where most management teams are geologists who are brilliant at finding deposits but terrible at financial engineering. The current market capitalization, last time I checked, was in the range where you're essentially getting the entire portfolio at a fraction of the NPV of Springpole alone. Now, NPV is a theoretical construct. I get that. It assumes things go according to plan, which they often don't. But when you're buying an asset at 10 or 15 cents on the dollar of its calculated value, you have enormous margin of safety. And that's before you factor in the potential for a genuine precious metals bull market. If we get the kind of monetary regime shift I'm describing, where gold goes to 3,000, 4,000, potentially higher over the next several years, the valuation of a development stage project like Springpole gets completely recalibrated. What looks expensive at $1,800 gold looks cheap at $3,000 gold. The economics scale in ways that most spreadsheet models don't fully capture. Silver adds another dimension to this. Springpole has significant silver credits. When silver catches up to gold on a ratio basis, and historically, it always does eventually, those silver ounces become substantially more valuable. You're essentially getting two metals for the price of one, and the market's currently valuing the project primarily on the gold. Here's the important part. You have to understand where we are in the cycle. This is not 2011, where everyone and their cousin was buying junior miners, and the sector was frothy with speculation. This is post-2013 bear market trauma, where most retail investors have completely abandoned the space. That's when you find the real opportunities, when assets are cheap, when nobody cares, when the narrative is entirely negative. The institutional side is starting to wake up, but slowly. You see it in the fund flows, in the conference attendance, in the M&A activity. Major producers are looking at acquisition targets because it is cheaper to buy ounces in the ground than to find them through exploration. When that arbitrage exists, the quality juniors get revalued or taken out. First Mining Gold sits in that sweet spot where they are too big to be ignored but too small to have full valuation recognition. The institutional funds that invest in mining ain't take positions yet because the market cap is not large enough. But as the company advances spring pole toward construction decisions, that changes. The eligible investor base expands. New buyers come in. The valuation gap closes. Timing this perfectly is impossible. I'm not suggesting anyone can call the exact bottom or predict the precise moment when sentiment shifts, but the setup is there. The fundamentals are there. The macro backdrop is there. And for those who understand the gold and silver thesis, for those who see the monetary endgame playing out, positions like this make strategic sense as part of a broader precious metals allocation. Let me share a perspective that often gets overlooked. Let's zoom out for a moment and talk about what's actually happening at the systemic level, because this context is crucial. The post-Bretton Woods monetary system that's been in place since 1971 is showing structural cracks. For 50-plus years, the dollar's reserve status allowed the U.S. to run persistent deficits without immediate consequences. The world needed dollars for energy, for trade, for reserves. So they bought treasury bonds, which financed American consumption and military presence globally. That system is fracturing, not collapsing overnight, but fracturing. The BRICS nations are actively working on alternative payment systems. Energy trades are increasingly settling in non-dollar currencies. Central banks are diversifying reserves away from pure dollar concentration. This doesn't mean the dollar disappears. It means the dollar's monopoly erodes, and with it, the ability to export inflation without consequence. What's remarkable about this is how few people in traditional finance are preparing for this shift. They're still operating under the assumption that the post-war order is permanent, that American financial dominance is guaranteed, that bonds and dollars will always be safe havens. That assumption is going to be extremely expensive for those who hold it too long. Gold doesn't care about these assumptions. Gold is simply reacting to the reality that every fiat currency in history eventually loses purchasing power. The dollar has lost over 95% of its value since the Fed was created in 1913. That's not conspiracy theory, that's just math. A dollar today buys what a nickel bought in 1913. And the pace of debasement has accelerated dramatically since 2008. Silver follows similar dynamics, but with more volatility because of the smaller market size. When capital flows into silver, the price can move violently in both directions. That volatility scares away institutional investors, which is exactly why the opportunity exists for those willing to handle the drawdowns. This reveals something important about market psychology. Most people want assets that only go up, never correct, and provide constant positive reinforcement. Those assets don't exist. Everything cycles. The question is whether you're buying assets that have fundamental value that persists across cycles, or whether you're buying narratives that depend on perpetual confidence. Precious metals have fundamental value that transcends any individual government or currency system. They're money that exists outside the banking system. They can't be printed, debased, or created by decree. That property becomes increasingly valuable as confidence in managed currencies erodes. First Mining Gold, in this context, represents leveraged exposure to that thesis. If gold and silver perform as I expect over the coming years, the mining sector, particularly the development stage companies with quality assets, will massively outperform the metals themselves. If I'm wrong, and we somehow return to the pre-2020 monetary normalcy, then positions like this will underperform. That's the bet. But look at the risk-reward. If you buy physical gold at current prices and it goes to $3,000, you double your money. If you buy a quality developer and gold goes to $3,000, you could see 5 to 10 times returns depending on the company and the execution. The downside is capped by the asset value and the jurisdiction. Canada isn't some frontier market where political risk is undefined. These are stable mining jurisdictions with rule of law. That asymmetry is what intelligent speculation looks like. You're not betting on lottery tickets. You're betting on defined assets being revalued in a changing monetary environment, with management teams that have the capability to unlock that value. Here's the thing most people miss about junior mining. It's not gambling if you know what you're looking for. It's pattern recognition, It's understanding cycles. It's knowing that when macro conditions align, capital flows into sectors that have been neglected, and those flows create explosive returns for those who positioned early. We're in that neglect phase now. The capital will flow. It's just a matter of when, not if. And the people who will capture that flow are the ones who did the work now while it's still uncomfortable, while the narrative is still negative, while most investors are chasing tech stocks and crypto and whatever else the momentum crowd is pushing. I've been in markets long enough to see this pattern repeat. In 1999, everyone owned tech and nothing else. Gold was dead. Miners were bankrupting. Then 2000 hit, and over the next decade, gold went from 250 to 1900. The mining stocks that survived went up 10, 20, 50 times. The people who made those returns weren't smarter. They just recognized the cycle was turning and positioned accordingly. We're at a similar inflection point now, different specifics, same pattern. Massive monetary expansion, currency debasement, fiscal unsustainability, geopolitical realignment, all the ingredients for a precious metals bull market. And First Mining Gold sits right in the path of where that capital will eventually flow. So what do you do with this information? That's up to you. I'm laying out the thesis as I see it. I'm connecting dots that the mainstream won't touch because it conflicts with their institutional imperatives. They need you buying bonds and index funds. They need you believing in the permanence of the current system. Your awareness threatens their business model. My only agenda is truth as I understand it, filtered through decades of watching these markets operate. I've seen what works. I've seen what doesn't. I've seen fortunes made and lost based on whether people understood the macro environment they were operating in. Right now, the macro environment is screaming at anyone willing to listen. Gold is telling you something. Silver is telling you something. Central bank buying is telling you something. Fiscal deficits are telling you something. Bond market performance is telling you something. The refusal of traditional safe havens to act safely is telling you something. This is the key insight. Everything is connected. The gold market isn't separate from the dollar. The mining sector isn't separate from monetary policy. First, mining gold isn't just a random Canadian junior. It's a leverage play on systemic monetary transition, wrapped in a specific asset with defined economics in a stable jurisdiction. You're early to this realization. Most people won't get it until it's consensus. And by then, the easy money will have been made. That's how markets work. They reward those who see clearly before the crowd, and they punish those who wait for certainty. There is no certainty. There's only probability and preparation. The probability, based on everything I am seeing, strongly favors precious metals and the quality companies leveraged to them. The preparation is doing your research, understanding the risks, and positioning appropriately for your situation. I can't tell you what appropriate means for you, but I can tell you that if the thesis I've laid out plays out, and I believe it will, the people who positioned now in assets like First Mining Gold are going to look back at this period as the opportunity of the decade. The information is out there, the data is available, the setup is visible to anyone willing to look beyond the mainstream narrative. What you do with that information determines whether you are a passenger or a participant in what comes next. That's it. That's the message. You're early. You have the perspective. Now the question is whether you act on it or whether you let the opportunity pass while you wait for permission from institutions that will never give it